Hello and welcome to Investment Blueprint for Passive Investing, curated by experts at Motilal Oswal. I am Muzzammil Syed and I am happy to take you on a 10-episode journey to help you build a portfolio with passive products. But before we do that, let me tell you a little bit about Investment Blueprint. Investment Blueprint is not just another investment guide. It's the solution to the problems that many new investors face today. Our goal is to help you make informed decisions that will help you build a portfolio that fulfills your goals. Our investment blueprint for passive investing consists of 10 chapters, each under 10 minutes. We start with the basics, explore the universe of passive investments, and show you various portfolio structures to choose from based on your individuality. The best part about investment blueprint is that we've given you a baby task in each episode. Activities in those baby tasks are designed to help you build your portfolio in a step-by-step manner and helping you gain a better understanding of the investment universe. So let's take the first step towards building a portfolio tailored to your needs with our first episode, Understanding Passive Funds. When it comes to investing, there are two philosophies, active investing and passive investing. Active investing involves selecting of individual stocks or funds with the aim of outperforming the market. Passive investing, on the other hand, aims to match the returns of the market by investing in a basket of securities that mirrors a specific index or a market segment. Let's understand a little more about each. Active investing is a strategy where an investor or the fund manager tries to beat the market average by selecting stocks and mutual funds or other investment vehicles that are expected to outperform the market. This approach involves conducting in-depth research and analysis of a company's financial statement, industry trends, and overall economic conditions to determine the stocks or funds that will perform well in the future. The goal is to create higher returns than the benchmark index such as Nifty 50. However, it is to note that active investing requires a lot of time, effort, and skill as it involves continuous monitoring and adjusting of the portfolio based on market conditions and new information which we get on the go. Additionally, active investing also involves higher fees as investors need to pay for all the work that we've done above, such as pay for research, transaction cost, the fund management fees, which can significantly eat into the returns that the fund provides. On the other hand, passive investing aims to match the returns of the market by investing in a diversified basket of securities that mirror a specific index or market segment. Passive approach involves investing in ETFs, which are also known as exchange traded funds or index funds that track a specific index or a benchmark like Nifty 50 as I told before. ETFs are a type of investment fund that trades on exchange like a stock. They represent a basket of securities that track a specific market index or a sector. By investing in an ETF, you are essentially investing in a portfolio of stocks depending on the type of ETF you choose. On the other hand, index funds are mutual funds that seek to track the performance of a specific market index, such as the Nifty 50 or the BSE Sensex. Fundamentally, one trades like a stock on the index, the other one is bought and sold as a mutual fund for your consumption. Like ETFs, index funds also offer investors a low-cost way to gain exposure to a diversified portfolio of stocks. Therefore, passive investing is a low-cost, straightforward approach that requires little time and little effort, making it ideal for beginners or investors who prefer a hands-off approach to investing. Instead of trying to outperform the market, passive investors aim to capture market returns by holding these stocks in a low-cost manner. There are various asset classes such as stocks, bonds, commodities that they can hold through passive instruments. One significant advantage that I would want to talk about passive investing is that it provides broad market exposure that reduces the risk of underperforming the market. Additionally, passive funds, like I said before, has far low fees that can help investors to save a lot of cost. This low cost structure translates into higher net returns for investors over the long run. In summary, active investing involves attempting to outperform the market, whereas passive investing aims to match the returns of an index or a benchmark. One requires a lot of time and effort, the other does not require a lot of time and effort. Active investing, because it involves a lot of time and effort, is expensive in nature, whereas passive investing is not expensive because it tends to follow the benchmark. Now, let's take a look at some of the ETFs and index funds that are available to investors in India, present across various factors, sectors, and sizes. Some of the popular ETFs and index funds are the Nifty 50 ETF, the Nifty Bank ETF, the BSE Sensex ETF, the Midcap 100 ETF, amongst many others. There are some ETFs and index funds that also allow you to invest internationally, such as America and emerging markets, also help you invest in certain factors which range around value, momentum, and low volatility, amongst many others that exist. As I said before, that every episode has a minor task that you would have to do that will take you one step closer to building your portfolio with passive products. This episode, we're asking you to do a task as well. So, after watching this episode, take some time out to reflect on your investment goals. I would really like if you could write down how soon would you want your goals to be fulfilled. Once you have a clear understanding of your short term, your long term, and all the other goals and milestones that you have in your life, I would like you to research some investment options that align well with your needs. While we are doing this show, I would also recommend you to go on the Motilal Oswal website and check out some calculators that will help you accurately map your goals as well as your earnings. I would request you to share your findings in the comment section of this video so that many others along with me would learn more about your investment journey and implement some from it. So this is the end of the first episode, and I hope that you learned the basic distinction between a passive fund and an active fund. In the next episode, that is top reasons to invest in passive funds, we will discuss the benefits in much more detail by having a conversation with Mr. Pratik Oswal, who heads passive products at Motilal Oswal. Remember, by dedicating just 10 minutes per episode to our investment blueprint, you can start building your own portfolio in a step-by-step manner and gain a better understanding of the investment universe. I would really request you to share this series with your friends and family members so that they can benefit from learning with us. Thank you very much for watching, and we'll see you around in the next episode.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.